I'm Matthew Galgani with part 3 in our series on how to use chart patterns to get in early on winning stocks. The double bottom is another telltale pattern the best stocks often form just before they make a big move. It looks like a lopsided W. It has a bit of a volatile look to it, and that's not a coincidence. You'll typically see double bottoms form when the overall market is also showing uncertainty and choppiness. Here's an example. This is a weekly chart for SolarWinds, which provides software for managing computer networks. In the summer of 2011, the general market showed a lot of choppy action, and SolarWinds formed a double bottom pattern around the same time. This line shows the price action of the S&P 500, which is often used to represent the general market. You can see that from July to early October, the market sold off sharply, then tried to rally a couple of times and came back down again. Most individual stocks simply follow the direction of the overall market, and that's what SolarWinds did. The double bottom you see here basically mirrors what was happening in the major indexes at that time. When a new uptrend finally took hold in October, SolarWinds broke out and launched a 137% gain over the next 11 months. And before it launched that move, SolarWinds was featured in the IBD 50 with an alert to the double bottom pattern and ideal buy point. Let's go over the main elements of a double bottom. Like with the cup with handle and flat base, you want to see a prior uptrend of at least 30% before the double bottom begins to form. The stock then pulls back to form the first leg down. It tries to rebound but hits resistance, then pulls back a second time. The total depth from the peak on the left to the low in the second leg should typically be 40% or less. Again, the overall market is likely showing similar choppiness at that time. Here's a key aspect of the double bottom. The lowest point in the second leg down should undercut the low of the first leg down. That serves as a shakeout of weaker holders, just like the handle in the cup with handle gets rid of less committed investors. It's important to have that shakeout because until the bulk of those weak holders are gone, every time the stock moves up, those investors typically sell, and that makes it more difficult for the stock to rise. Once they're gone, it leaves just those more committed investors who continue to scoop up shares as the stock forms the right side of the base. The total length of a double bottom should be at least 7 weeks. You start the count from the first down week in the base. For all bases, the ideal buy point is determined by the most recent point of resistance. For a double bottom, that's the middle of the W, where it bumped its head and fell back to form the second leg down. So to calculate the ideal buy point, add 10 cents to the peak in the middle of the W. And also, just like the cup with handle and flat base, you want to see volume be at least 40 to 50% higher than normal on the day of the breakout to show strong institutional support. Let's look at another double bottom pattern in action. Here's a weekly chart for Lululemon Athletica from 2010. Here's the double bottom it formed. Did it have a prior uptrend of at least 30%? Yes. Did the low of the second leg undercut the low of the first leg to shake out those weaker holders? Check. Was it at least 7 weeks long, starting with the first down week in the base? Yes, it was a 12-week pattern. The ideal buy point is calculated by adding 10 cents to the most recent point of resistance, the peak in the middle of the W. So the price point for Lululemon was $43.47. And IBD alerted readers to that buy point multiple times in multiple features before the breakout, including in the IBD 50. So if you were doing a regular routine, you would have seen the analysis that said Lululemon marches near possible $43.47 double bottom buy point. You would have also seen that it had explosive earnings growth and other CanSlim traits. Annual EPS growth was 64%. It posted triple-digit earnings growth in the prior quarter, and sales growth in the most recent report was a stellar 56%. Its EPS rating was the highest possible 99, meaning it had better annual and recent quarterly earnings growth than 99% of all stocks. And it had an exceptional return on equity of 30%, nearly double the 17% minimum we look for. The point is that Lululemon wasn't just any old stock forming a double bottom. It also had market-leading fundamentals. It's that combination of strong fundamentals and solid chart action that makes for a true market leader. Here's Lululemon's double bottom on a daily chart. Note this big gap up within the base, and look at the huge spike in volume. It was 612% higher than normal. It's healthy to see that kind of heavy volume gap up, which happens when demand is so strong that the stock instantly jumps to a much higher price, rather than going up incrementally. That's a clear sign that big investors are scooping up shares. Here's where Lululemon broke out on September 14, 2010. Note that was only a couple of weeks after a new market uptrend began on September 1st, again showing how the top stocks often form bases during a correction, then launch new moves right when a new uptrend begins. As breakouts go, it wasn't a very decisive one. It closed just barely above the ideal buy point, and volume was a little light. It was 29% above average, a bit less than the 40 to 50% minimum spike you look for. Over the next few weeks, Lululemon traded essentially sideways, moving higher on certain days but pulling back on others. That's not unusual. Stocks will often pull back after a breakout, then move decisively higher later. So stay patient when that happens, and here are two things that could have helped you sit tight. First, Lululemon never dropped to 7% below the ideal buy point, so it never triggered the rule that says to always sell any stock that drops 7 to 8% below what you paid for it. Second, look how it basically found support right around the ideal buy point. That shows big investors are sitting tight and quietly picking up more shares in that price range. And note how heavy volume did start to kick in during that time, another sign of institutional buying. What happened next? On this weekly chart, you can see that after breaking out of this double bottom, Lululemon rose 196% in just 10 months. So as you look to build your watch list, focus on stocks that have explosive earnings growth and other CanSlim traits and are forming a telltale chart pattern, such as the double bottom. You'll often find early alerts to such stocks in the IBD 50, Your Weekly Review, and other IBD features. To learn more about charts, base patterns, and other key investing rules and strategies, regularly read the Investors Corner columns, which you'll find under the IBD University tab on investors.com. Thanks for watching.